When most people start investing, they picture their money compounding year after year, until one day they're financially free. Sounds great, right? But here's the reality. Most beginners don't end up there. Instead, they get frustrated, they lose money, and they wonder why it feels like everyone else is getting rich except them. It's usually not the stock they chose, it's the mistakes they made along the way. So common mistakes that almost every beginner falls for them. And in this video, I'll show you how to avoid these traps and actually give your money the chance to grow the way you want it to. The first big mistake beginners make is trying to time the market. It feels logical. Buy low, sell high. Sounds simple, right? The problem is, nobody can consistently predict when the highs and lows are actually happening. The market moves in ways that feel random in the short term. You'll see a dip and think, okay, I'll wait for it to go lower. But just when you're waiting, the market shoots back up. Or you'll buy in because you think a rally is starting, and then it drops the next week. The truth is, timing the market is more like gambling than investing. History shows if you invested $10,000 in the S&P 500 back in 1995 and just left it alone, you'd have turned it into more than $200,000. But if you missed just the 10 best days in that entire period, you'd have almost half as much money today. Just 10 days. That's how costly market timing can be. The truth is, it's not about timing the market. It's about time in the market. The longer you stay invested, the more chances you give your money to grow. The second big mistake is panic selling during volatility. And this one is really tough because it plays on our emotions. When you see your portfolio dropping every day, your brain goes straight into survival mode. It feels like the only smart move is to get out before things get worse. Think back to March 2020. The S&P 500 fell nearly 30% in just a few weeks. Headlines were screaming about a global recession, businesses were shutting down, and uncertainty was everywhere. For a lot of beginners, the fear was overwhelming. They sold everything, convinced they were protecting their savings. And in that moment, it really did feel like the safe decision. But here's what actually happened. Within months, the market had fully recovered. Not only that, if you held on, your portfolio doubled in value over the next 18 months. That's the real danger of panic selling. A drop on paper only becomes a real loss the moment you sell. Ups and downs are a normal part of investing. They're not a reason to run. They're just the cost of long-term growth. One of the most important rules before you start investing is to have an emergency fund.